Good morning, and welcome to the conference call for Tate Lyle's Q3 trading statement. Your speakers today are Nick Hampton, Chief Executive, and Sarah Cowers, Chief Financial Officer. I will now hand you over to Nick Hampton for some opening remarks.
Thank you, operator. Good morning, everyone, and thank you for joining this third quarter conference call. I will start by making a few remarks on our performance and strategic progress, and then we'll open it up to Q&A. Trading in the third quarter was in line with our expectations and consistent with the first half. Our guidance for the full year remains unchanged. On a pro forma basis and in constant currency, revenue was 2% lower in the quarter, reflecting continued muted market demand, with performance in all regions broadly in line with the first half. On a reported basis, which includes CP Kelco from the date of acquisition on the 15th of November 2024, group revenue was 15% higher. For the 9 months to the 31st of December 2025, on a pro forma basis, revenue in the Americas was 2% lower, with modestly higher pricing more than offset by lower volume. In Europe, Middle East and Africa, lower pricing resulted in 5% lower revenue. While in Asia Pacific, revenue was up 1%, driven by higher volumes. Turning to the renewal of customer framework agreements for the 2026 calendar year, which is well advanced. With our number one priority returning the business to top-line growth, we have selectively chosen to invest to drive volume and revenue growth. This is the right thing to do for the business, giving us a stronger platform for future growth, and we are pleased with the engagement from customers to our expanded offering. We are making good progress on the series of actions we set out at our interim results to drive top-line growth and improve performance. Let me give you 1 or 2 examples of progress. We continue to accelerate the rollout of our solutions chassis program with a focus on mouthfeel. We launched 2 new mouthfeel chassis in the quarter, one to improve the stability of pourable salad dressings and another to support egg reduction. The level of customer engagement on our enlarged portfolio remains high, with the value of cross-selling opportunities in our new business pipeline increasing by more than 1/3 in the quarter. Revenue synergies from the CP Kelco combination are growing in line with our expectations, and we remain confident that run rate cost synergies will exceed our target of $50 million by the end of the 2027 financial year. And finally, our 5-year, $200 million productivity program continues to operate well, with further savings delivered in the quarter. Overall then, I am pleased with the progress we are making. There is a real determination and focus across the business to deliver on the actions we are taking, and I am confident that in the near term they will improve the top-line performance of the business. We will give you more detail on our progress when we announce our full year results in May. At that time, as usual, we will also provide guidance for the 2027 financial year. To conclude, with our leading positions in sweetening, mouthfeel and fortification, we remain well placed to benefit from the global trends towards healthier and more nutritious food and drink. With the breadth of our portfolio, our formulation expertise, and the targeted investments we are making to accelerate customer wins in key growth areas, we are well positioned to drive profitable revenue growth over time. With that, Sarah and I would be happy to take any questions.
Thank you, sir. If you wish to ask a question at this time, please signal by pressing *1 on your telephone keypad. And please make sure the mute function on your phone is switched off to allow your signal to reach our equipment. If you wish to cancel your request, please press *2. Again, it is *1 to ask a question. We will now take our first question from Karel Zoete from Kepler Cheuvreux. Please go ahead.
Yes, good morning all. Thanks for taking the question. I've 2 questions. The first one is in regards to the price investment you mentioned to sustain volume growth or to improve volume growth. Can you be a bit more specific which markets you decided to invest and what that might mean for pricing going forward? And the other question is around fibers. I think more and more evidence or discussions in the public domain about fiber. the fiber being the new protein, etc. What kind of engagement do you see with your customers on the fiber ingredients you sell? Thank you.
Okay, Carol, let me pick up on the fiber question first, because I think it's an important one, and I'll let Sarah handle the selective view on pricing. Look, I mean, fiber clearly is a big global trend. In fact, there was an article yesterday in Bloomberg about fiber maxing, and we're seeing very encouraging progress with customers on our fiber portfolio, both products going into market, notably in the US market, where in both beverages and dairy, we're seeing a fiber fortification as a trend, and increasing the pipeline for fiber is growing. But it's a global trend as well, and we're seeing that trend across Europe and Asia too. And I expect that to continue as we think about the continued desire to create more nutritious processed food, especially in a world where people have a significant shortfall of fiber in their diets, and all of the nutritional trends we're seeing point towards fiber addition as a strong growth opportunity for us going forward.
Thanks, Nick. And Carol, good morning. So when we think about our framework agreements, I think it's worth taking a step back, and we're all very aware that market demand remains muted. And as we stated, our number one priority is to deliver the top line growth. So that's volume and mix driven top line growth. So we've taken the decision to set our business up stronger for the future, is that we're selectively investing to drive that volume momentum and the revenue growth. So we want to think about this as, we're being very selective, so it's by product, by customer, by region, to ensure that we're setting ourselves up for that growth, given we now have the broader portfolio following the acquisition of CPK.
Okay. Thank you.
Thank you. Our next question is from Ranulf Orr from Citi. Please go ahead.
Hi. Thanks for taking the question. Just one from me. I mean, you talked a bit in the past about the sort of 4Q improvements. Could you just provide a bit of an update on that? What's going well and where you have visibility on some of those sort of factors coming through? Thank you.
You mean in the fourth quarter?
Yes. Yeah.
I just wanted to get clarity on the question. Look, so I mean, I think we're seeing encouraging signs of increased customer engagement on reformulation. It's very clear the sentiment in the market is, my customers at least, increasingly thinking about the need to put price back in to drive momentum. But we're not assuming any improvement in market outlook in the fourth quarter in our underlying guidance for this financial year. What we saw in the third quarter was consistent performance with the first half and very clearly in line with our expectations. And so far as we've entered the fourth quarter, we'd say the same. Always, as you go from Q3 to Q4 and across a calendar year, you can get some kind of pluses and minuses between December and January from a phasing perspective. But we're seeing the kind of customer demand that we would be expecting given the underlying guidance given for this year.
Okay, that's very clear. And just one more, if I may. On the price investments for the year ahead, can you give any kind of quantification or indication of the scale of those, maybe in relation to the current year? Thank you.
Look, I mean, I think we haven't finished yet because we're still closing out the renewal of agreements for this calendar year. And we'll give you a precise view on that when we get to our May results as things have settled down. But I think it's fair to say that a little bit more this year than we did in this calendar year than we did in the last calendar year to ensure that we're really driving momentum with key customers. And you're obviously offsetting that with real focus on productivity and the benefits of the combination coming through in both cost synergies and the revenue synergies, of course, because let's not forget this is now the second year of the new business. And this is the first year we're entering as one combined business.
Thank you. We'll move to our next question from John Lim from BNP Paribas. Please go ahead.
Hello, morning all. quite a few of my questions have been asked, but maybe just could you provide more color on trends by regions and category? Like, for example, which category has been doing well, or you're seeing more uptake with customers? So you mentioned a bit about fiber. Is that more driven by innovation in beverages, for example, and supported by GLP-1 users taking more fiber? My second question is, do you have any indication of how FX will be like for the next year? And lastly, maybe an update on CP Kelco's volume and margin recovery, please. Thank you.
Okay, so let me give you some headlines on the overall shape of what we're seeing in the market, and then maybe Sarah can pick up on the Forex and the CPK question. I mean, overall, what we saw in the third quarter was quite consistent with the first half. In the Americas, we're seeing modestly higher pricing, more than offset by lower volume. And that's very consistent with the Nielsen volume data that we saw in the first half, where you saw volume down and value driven by pricing, which was, in part the pass-through of tariffs at the time, if you remember. Then that seemed pretty consistent. In Europe, volume pretty flattish, volume mix with, the pricing investment driving lower revenue. And then in Asia, encouragingly, some revenue growth driven by higher volume, so some signs of momentum. I think underlying that, though, it's important to say what we're seeing with customers in terms of trends is some clear benefits of the combination flowing through. So in the quarter, the cross-selling pipeline was up over a third, having been strong at the first half. And we're seeing double-digit growth in our innovation pipeline to customers. And that's driven by some key themes. So as we've already talked on the call, we're clearly seeing a focus on fiber fortification across many categories. And Joe, I think it may well be driven by this need for nutritional density, driven by nutritional needs for processed food and the GLP-1 point you made. We're seeing that especially in beverages and dairy in the US. In EMEA, we're seeing dairy and beverages being more resilient, data and snacks a bit softer. And in Asia, actually, overall robust category performance. We talked about recovery in China at the half, driven by CPK. Beyond fiber fortification, the other trends we're seeing is renovation for value. So, cost efficiency and product renovation. We're also seeing continued focus on sugar reduction, and that linked to mouthfeel that we talked about at the half, where, as you take sugar out, being able to control the texture and mouthfeel of a product is really important, and that's where the combination is really helping us build a stronger pipeline, which we expect to build as we go into next year.
Thanks, Nick. And Joan, the next question is about Forex. So indeed, we saw a headwind of given the US in the first 9 months, which is approximately 2% to 3% of revenue, and that we expect to continue. That is partly offset by the strength in euro. And remember, with the acquisition of CPK, we now have a broader footprint, so there's also some impact of Brazilian real, Danish krone, etc. But overall, a headwind in the sort of the 2-3% on the top line. That's a slightly higher impact on EBITDA, given the important contribution from the profitable North American business. Turning to CPK, so clearly the integration continues to go well. Cost synergy is well in hand. And as Nick has spoken about, now obviously the attention on the pipeline growth of those cross sells, and it's been really powerful going into the conversations this year as a combined portfolio, fronting up our the combined commercial staff, really demonstrating the ability and the strengthening capability of the portfolio and the stronger together. I think very powerful. Good to see.
Very helpful. Thank you.
Our next question is from Setu Sharda from Barclays. Please go ahead.
Hi. So my question is on the selective investments. How should we think about the margin impact of these investments as we move into FY27? Are you viewing this as a one-year reset to drive volume recovery or a more structural change in pricing intensity? And my second question would be regarding to what extent can be the ongoing productivity program and CP Kelco cost and revenue synergies can offset the margin impact of these investments? Should we expect net margin pressure or stability as we bridge from FY26 into FY27?
Okay, so I think let me start by saying we'll give very clear guidance on fiscal 27 when we get to full year results. As we need to complete our planning process for next year and see how trading evolves in quarter one of the calendar year. But the way I think about it is, if you think about the building blocks going to next year, we're clearly, because of the market demand remaining muted, putting some selective investments into price to drive the top line, both volume and revenue. Alongside that, we've got clear offsets from productivity delivery and accelerating the benefits of the CP Kelco combination. And different to last year, we've also got the benefits of the combination flowing through in terms of the pipeline and the cross-selling opportunities to support the framework agreement renewal. So we're confident that that builds a strong platform for growth. Where that leads us to on overall earnings delivery and margins will be much clearer about when we get to our full year results. But the key here is the quality of the portfolio to build a growing pipeline of business for customers. As we see markets start to improve and the trends that are, our friend from a positioning of the business perspective, we fully expect to drive profitable growth going forward and into the medium term. And we'll give very clear guidance on the nearer term when we get to our May results.
Thanks for that. Just a follow-up on the fiber thing. Thanks for giving some color on that. So are you seeing a meaningful increase in customer briefs or RFP activity linked to high fiber formulations? And how does the current pipeline compare with the time last year?
So if you think about our pipeline in the last quarter, it grew double digits overall. And that is driven by a focus on things like fiber fortification. I think the question always is, at what pace do those pipeline projects convert into innovation in the market? And as you know, we've probably seen, we haven't really seen an increase in innovation pace yet, but we're anticipating that coming as these projects start to flow through.
And Nick, maybe I've just add, it's not simply just adding fibre to a product. With fibre, you really need the mouthfeel. And that's really where it plays to our sweet spot, because you really need the appealing mouthfeel for the fortified product to be successful in the market.
Thank you. That's quite helpful. Yeah.
Thank you. We'll now move to our next question from Samantha Derbyshire from Goldman Sachs. Please go ahead.
Good morning. Thanks for taking my question. I just kind of wanted to talk about some of the themes you're seeing in the market longer term. So we heard a lot of feedback at CAGNY last week about clean label reformulation, including away from artificial sweeteners like sucralose and several emulsifiers, some of which I think are in your portfolio. What proportion of products are being reformulated this way? And is the increased customer opportunity that you're seeing with CP Kelcos from fortification and protein and fiber, is that enough to offset this headwind? Are you still seeing structural growth in the way that customers are reformulating with your ingredients? Thank you.
So thanks for the question. I mean, all of those trends that we talked about at CAGNY this month actually play to the reshaping of the portfolio. And I think it's important to say that sucralose clearly is an important part of our portfolio as our artificial sweetener of choice, but it's growing in demand. And we're selling every kilo of sucralose that we can make because it's the best tasting artificial sweetener out there. It's also important to say that if there was a shift away from artificial sweeteners, we've got lots of non-nutritive natural sweeteners in the portfolio, everything from stevia. We're the only company with a all-America supply chain for stevia, for example, through to monk fruits and allulose. So we're well placed for the reformulation to more natural and clean label. Emulsifiers actually aren't part of our portfolio. We do a lot of replacements of emulsifiers, and that's where the CP Kelco portfolio comes in as well. So all of the trends that we're seeing people talk about are the trends we really believe the combination of our three core platforms can help customers with. Because that sugar replacement or artificial sweetener replacement that we talked about also comes with the need for mouthfeel modulation, as Sarah just talked about. So the things that we heard from CAGNY are precisely the reason that we've repositioned the business the way we have done in the last 5 years.
Thank you.
And then we'll to our next question from Matthew Abraham from Berenberg. Please go ahead.
Morning all. Thanks for taking my questions. Just first one relates to the fibre fortification services you've touched on. Just wondering if you can provide a sense of the margins from those services relative to the rest of the group. If fibre demand does accelerate meaningfully, could there be a broader impact on overall group margins? And then the second question just relates to the price investment commentary that you've provided. Is that a reflection of a perception of improved demand elasticity, or is it more a reflection that demand is such that it requires stimulation through price investment? Thank you.
So on your first question on fibre, our fibre portfolios generates very nice margins for us, and obviously it depends on a customer by customer basis how much fibre we're using, what other components we're putting in to help with that solution. But I think the key is the fibre fortification trend is driving a solutions model where typically that business is stickier business and good margin business. So it's certainly helpful in that regard. In terms of your question on price and price elasticity, we're clearly in a world where consumers are more challenged. Food is 20 to 30% more expensive than it was pre-pandemic because of all of the geopolitical challenges we've seen over the last 3 or 4 years. And there clearly is a requirement for some price stimulation to drive demand. But more importantly for us, we're trying to balance the way we think about growing our business to make sure we're well positioned for growth through the cycle. And in a cycle where demand is more muted, we want to make sure we're stimulating growth so that we're well positioned as markets start to improve.
Excellent. Thank you. I'll pass it on.
Thank you. As a reminder, to ask a question, please signal by pressing star 1. The next question is from Lisa De Neve from Morgan Stanley. Please go ahead.
Hi. Thank you for taking my questions. I have 2. First, can we talk a little bit about what you're seeing in APAC? Various players in this reporting season have noted an improvement in China specifically, and I believe your sequential local currency growth is modestly better in APAC, so any color on that would be great. That's one. And secondly, can you provide us a little bit of color on how your raw materials are trending into this year on average? How should we think about the direction for cost input inflation or deflation? Thank you.
So maybe let me pick up the APAC question. Sarah can pick up the input cost one. Look, I mean, we're encouraged by the progress we're seeing in Asia. As you mentioned, we did see some improvement in China in the first half, and that continued through the third quarter. I mean, it's difficult to talk about Asia as one region because it's actually a vast area, but we're seeing good progress in China, solid demand in North Asia, across Japan and Korea, and that gives us some encouragement for the future. And if I look at APAC in the broader suite, we've grown our business significantly over the last 5 years. We're now a $500 million business revenue when we were around about 105 years ago. And it's a huge growth opportunity for us still because it's 60% of the world's population, and a lot of the trends we've talked about on the call are true in Asia as well. So the opportunity there is very clear, and the fact that we're starting to see some stability and improvement is very encouraging as we go into the next 12 months.
Thanks, Nick. And then, Lisa, on the raw materials, I think it's worth reminding you that we've now got a much broader array of raw materials post the acquisition of TPK. So it's not just corn, it's also pectins and seaweed, etc. And broadly, it's a more benign environment. There's not a strong inflationary push coming through there. So it's more benign, and we're well diversified.
Thank you.
I think it's fair to say we're seeing pretty flat year costs in it overall. I mean, with some ups and downs, but nothing significant.
Yeah, indeed.
Thank you. It appears there are currently no further questions in the queue. Pardon. We have a follow-up question from John Lynn from BNP Paribas. Please go ahead.
Hello. Sorry, I'm just squeezing in one more question because everyone seems to be asking about margins. Nick, you've historically talked about how important it is to protect unit margins. Has this changed? Are you confident of maintaining unit margins this year?
No, I think the focus on unit margins hasn't changed at all. I think in the near term, we're trying to balance all the levers we have to get the business back into top-line growth. And doing that in an environment where markets are more sluggish means we're having to make some choices about where we invest and what choices we make. But fundamentally, over time, we expect to focus on maintaining unit margins and using mix to improve margins to the quality of the portfolio. We're in a cycle at the moment where we're having to make some choices.
Okay, it's reassuring to hear that you're confident of maintaining the unit margins. Thank you very much.
Thank you. With this, I'd like to hand the call back over to Nick Hampton for any closing remarks.
Thank you, operator, and thank you, everybody, for your questions. So just to summarize, trading in the third quarter was in line with our expectations and consistent with the first half, and importantly, our guidance for the full year remains unchanged. As we talked a lot about on the call, our number one priority is returning the business to top-line growth. And we're clear on the actions we're going to take to improve top-line performance of the business in the near term. We remain focused on top-line growth, execution, and delivering for our customers. So thank you for your time and questions, and I wish you all a very good day.
Thank you. This concludes today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.